My name is Paul Brandt. I'm with Clear to Close Brokers. I'm wearing my Yes shirt today, Sam. You can't see it because of this thing. Yes shirt, because we like to say yes to all people that want to buy homes. Sometimes, though, credit score is more than ever an obstacle, right, in getting them approved into their first home. And that's where you, Sam, come in. I want to introduce Sam Parker with My Credit Guy, and we're going to have a great conversation. How you doing today, Sam?
I'm great. Thanks for having me, Paul. I appreciate it. And yeah, I think that, credit's that thing that some people know about and they're just not quite sure how bad it is. Right. Some people think it's worse than it is. And some people, it comes out of left field. They go to apply for, for a home loan. They say, I got a great job. My credit has to be good enough. And then it's like that sucker punch from left field. And they're like, oh my gosh. So there's just so much, misinformation about credit. And, even the people that have good credit a lot of times are there kind of out of blind luck or doing the right thing by accident.
What's interesting? You bring that up, Sam, because a lot of people come to me and they go, Paul, this is gonna be a two-part. We're gonna, Paul, can we just do a soft inquiry? I just checked my credit score. I'm just making this up. It's 750. Then when we eventually pull it, Sam, the credit score is not 750. 99% of times it's lower and it's in the 60s, and they're really confused. How come when they look at the free credit report scores, it's lower than when I pull it?
Yeah, great question. So first of all, there's two different major scoring models. There's FICO and there's Vantage. Almost always when someone's pulling credit online, it's going to be the Vantage scoring model. So not even the same company that's deriving the credit score that's applied to the mortgage scenario, right? On top of that, even if you are pulling a FICO credit score, more than likely it's a consumer model. There's dozens of different FICO models. And the only one that is the mortgage score is the mortgage score, meaning that the only place that you have access to that is myfico.com. You can select the mortgage score, but it's expensive, or the mortgage professionals have it, right? So almost everywhere that a consumer is pulling credit online, it's going to be looking at a similar but different scoring model. So different calculations are being made, and therefore your credit score is going to come out differently. You got to keep in mind too that a lot of those sites that you're pulling your credit on, really what they are is sales funnels. They give you your free credit rescore, but nothing's free. They want your data. The reason they want your data is to sell to you. So what they'll do is they'll tell you have a 750 credit score. And then based on that 750 credit score, they'll offer you a credit card over here that would be for somebody with a 750. However, the credit score they're showing you is not accurate. So then when the credit score is pulled by the credit card company, now they're offering you a credit score that's based on your real credit score, not the one that they actually just showed you even. So it's just a sales funnel, kind of in some cases, I believe, kind of a bait and switch situation.
Yeah, sounds that way. That's actually great information. I didn't know that. So you can actually go to myfico.com and select the mortgage credit score.
Yeah.
And be able to pull the same score as I will.
So here's the deal. They say it's the same credit score. I don't believe that. I think it's off by a little bit, but you have some people that say that it's absolutely where you can get the only place that you can get your true FICO, the mortgage pull, but I still don't see it being apples to apples. I still see it typically being off by at least a handful of points, and therefore I would still rather just look at a less expensive consumer model, knowing that the scores are going to be a little bit different, and then always defer to the mortgage pull when it's time for that.
Well, let me ask you this, though, because a lot of people, this is the biggest question I get. Well, I don't want you to pull my credit score, my credit report, because it's just going to crush my credit score. I've worked so hard on it.
Yeah.
Is that true?
Well, no. It's great that somebody's in that mindset, though. It's great that they're in the mindset of wanting to protect their credit. I'll tell you two people that worry about inquiries, okay? It's the people that are very protective of their credit that have done a great job, and it's the people that don't want to face the music. It's the people that say, oh my gosh, look how many inquiries I have. That's what's the problem. And I look at it, I go, look at your 8 collections, or your 3 late pays, and it's like, because to answer your question, when a lender pulls credit, it's going to hurt somebody anywhere from 0 to 3 points typically, but nothing of note. And the bottom line is, Paul, they're trying to borrow hundreds of thousands of dollars from you, if not $1 million or more. you got to let somebody pull your credit. You're going to somebody asking for a lot of money. You can't say, but I don't want you to see if I'm a good risk or not, because that's really what a credit report is. So first of all, no, it's not going to hurt the credit score much. And if somebody, like if a lender pulls, if somebody made the mistake of like going online or going to a big, box lender and then came to you, Paul, within that 30 days, they can pull credit again, and it's not going to affect their credit score at all. So they can get that quote from you and not worry about, their credit score being impacted at all if it's within 30 days of it being initially pulled in the same industry.
So it only affects your score up to 3 points on the initial.
Yeah. In general, yeah. I mean, it depends on the overall makeup of the credit profile, but on the vast majority of credit, and if you're watching this on your credit, more than likely, it's not going to hurt your credit by more than just a few points. And again, it's a necessary evil. So you don't need to be worried about it dropping you, 20 points or 30 points or anything like that. Now, are there freak situations where somebody's at a 721, you pull credit and it drops them to a 719? That happens, and then we can easily look at that credit report and find another 15 points for that person by paying a credit card down by $36, usually something weird like that.
That's very interesting. Just to kind of piggyback off that, a lot of people think and correct me if I'm wrong, that the credit score is a stagnant number. Like if I have a 765, that's what I have throughout the month. But isn't it true every time they pull their credit card out to pay for something at the store, that could impact their credit score? Probably.
Yeah.
Right?
Yeah, so there's going to be some staggering of different dates where creditors report, where the credit bureaus get that information, apply it, and then we even see a little bit of a lag usually between the information being updated and the credit score being updated fully as well. So it's a constantly moving thing where if I pull credit 5 days ago, I probably shouldn't have the exact same score. Now, it might only be different by a couple of points, but it's going to be rare that it would be the exact same credit score. There are a couple of kind of milestone dates throughout the month where you should see a bigger increase, like meaning like if I went and I paid off 3 credit cards and I looked at my credit 5 days from now, even if the balance is updated, more than likely my score has not seen the full impact of those 3 cards being paid down. We usually see that full update on or after the 8th of the month, and that's just because the credit bureaus typically update on or before the 5th. We found, and then there's usually anywhere from a 2 to 3 day lag between those updates and the score. So when somebody wants to be really safe, like we have people repulling credit every day of the month and confirming closings, but if somebody has the time and they want to just say, hey, I just want the full effect of this last round of disputes or what I did last month to hit my credit, depending on the date, like usually if they've done that action by the 20th or before, we usually like them to do it by the 15th, meaning if you make a payment by the 15th of this month, then next month on the 8th, it should be updated. Now, if you make a payment after the 15th, and this is just in general, you can consult each individual credit card company, auto company, or whatever, and they'll tell you their reporting date. But in general, if you wait until after the 15th, you're running the risk at least of missing that next reporting update of your balance. So, and getting the full effect. So it is a constantly moving thing, but then there are also definitely certain dates where if certain things are done by those dates, both positive and negative, where you would see a major update of the credit typically as well.
So interesting. So if because I do have borrowers say, hey, Paul, I don't want you to pull my credit because I'm about ready to pay off a lot of debts and I really want to get the best score possible. Yep. So in general, you're saying is if they make those payments before the 15th of the month, by next month after the 8th, they should, in theory, all be reflecting?
Yeah, in general, that's what we've seen. And again, I'm not talking about any, because when you try to talk about the rules involved with credit reporting and the credit bureaus, the problem is that they're just broken so often. So, or they're put out there the way it should work like this, and then it doesn't work like this. So what I'm doing is just sourcing tens of thousands of files that I've worked on over our career, and just saying, hey, typically this is what we're seeing. You know, as long as you make that payment by the 15th. Now, the other thing that you can do, you know, if you're in that space, if you're in that headspace, and you're like, I do not want you to pull credit if you don't need to, or if it's not updated yet, you can always flip over to a consumer report, because the data on a consumer report to a mortgage report should be the same in terms of an update, as long as it's a refreshed credit report. But the scores are just going to be different. So you can always go and say, hey, we got to see if the credit card balance even updated yet. And you can double check on a consumer source and then verify that it has been updated at the bureau level, because it's reporting that way, and then do a mortgage pull if you're worried about that inquiry.
Interesting. So speaking of different credit scores, typically when we pull from all three credit bureaus, and most of the time they're in the same ballpark, but every once in a while you get one that says 650, 717, and 750. It like doesn't even make sense. Like, where does that may be a little bit of an exaggeration, but where does that one bureau get the 650 from?
Yeah, so it's not a huge exaggeration. It's because if you have, like, for instance, a collection company, okay? So let's go the negative route. If you have a collection company that only reports to Experian, and you get a medical collection for $12 and it shows up on your Experian, especially if you have mid 700s, a really good credit score, you are going to probably see a 60, 80 point drop, because the higher your credit score gets, the more fragile it is, the more of an impact a negative is going to have. So we're covering a couple different, things here. But so on that note, if you have a 720 credit score, an 800 credit score, and you add a late pay, you're going to see a huge drop in credit, because it's a fragile thing once it gets higher. Whereas if a 640 credit score adds that same late pay, they might only drop 20 points, right? So it's crazy how that works. Geez, where did we start with that? I got off.
I can ask right now the differences between a 650 and a 770.
Yeah. Sorry. So,
okay, but it's
so first of all, you have the negatives that could be reporting, and then the same thing with the positives. Like, I'm from Iowa originally, right? And so in our small farming communities, if I go to Farmers Savings Bank and they only report auto loans to Equifax and TransUnion, then, and I'm not saying they do, Farmers Savings Bank, I'm sorry if you report to all of them, my bad, that's a real place, and I banked there when I was a kid. So but if they only report to 2 of the 3 credit bureaus, then that 3rd credit bureau is going to have a lower credit score, as long as my payment history is positive. So to answer your question, they might have different information being reported to them, and they do all have slightly different scores, but that wouldn't account for that one outlier being 80 points different. There is going to be something different reporting on that one that's not reporting on the other 2.
Okay, so I got a lot of questions just based off what you just said.
Yeah.
So let's start with collections.
Yep.
Good or bad to pay them off? What I've heard is once you pay a collection off, it immediately drops your score.
Yep.
Is that true?
Yeah. So to answer your question, in terms of paying collections off, in life, good to pay them off. In credit, bad to pay them off. So you have to find that middle ground. And this is one of those situations where it's messed up. When you pay a collection off, you update what's called the date of last activity, which hasn't been updated since the last time that you made a payment. And that kind of keys how old an account is, how much it's active, basically. If the credit bureaus are seeing it as an active collection. And so when you pay it off, like let's say it was from 3 years ago, well, that thing's been dormant for 3 years. And so even though it's hurting you less and less and less every year. And then you go to apply for a home loan and the underwriter says, hey, listen, this thing has to be paid off or else, we're not doing this. Or you think that you're going to jump your credit score up, so you start paying them off. What you do is you update that date of last activity to today's date. Credit scoring algorithm thinks it's a new collection, basically, for the most part, and it's going to drop those credit scores. But if you're going for a home loan, you also have that underwriter in the background saying these things need to be taken care of. So you got to do it. So what do? Well, first of all, we make sure that that item is valid. So if it's invalid, if it's outdated, if the client disagrees with it, whatever, we can challenge the item and try to get it removed or updated. If the client's just not sure, we can ask them for verification, which still makes them legally jump through the hoops and prove that something's accurate, or they have to remove it. And if it is accurate, then we want to go for what's called a pay for deletion, where we're offering them payment, but only if they agree to delete it. If we end up with a collection company that says, listen, we're not going anywhere, we're not deleting this thing, and the underwriter doesn't care about it, then typically we would work around that collection and kind of come back to it later, because more than likely there's going to be a rare situation where it's the end all be all. Like, I had a 720 credit score, this collection got added, now I'm at a 650. If I don't get it removed, my life's over, right? And then we have to focus on that thing and get it taken care of. But in most cases, it's like, if this creditor doesn't want to work with us, we'll go and see if 2 or 3 of the other guys do want to.
So interesting. So you can work with them and say, hey, we're going to pay for this, we're going to pay this, but we don't want you to update that. What was that system you called? What's it called, Sam?
It's a pay for deletion offer.
No, that one system where it you make it active again. So if you had a collection on there for 4 years, because you haven't made any payments or any new collections, it looks like you haven't had a collection for 4 years. But once you pay it, it's reactivated.
It's not that it doesn't look like you've had it, it's that time heals on credit. So the further and further that you get away from like a negative action on your credit report, the less risky you are. It's a risk-based model. So the calculation is showing how likely are you to default on a loan. It's not a good thing, right? Like, the model is set up for banks to see if you're a good person to lend to. So it's a risk-based model. And the further that you get away from the last time that you went bad on something, the less of a risk you are. And so it's just that mechanism that when you update it, it's one of those rare places where the model's not intelligent enough to say, this isn't a bad thing. It just sees a negative account with an updated date. And it doesn't see $0 balance. It doesn't care about paid. It just sees negative account, because there's a rating system in credit. And this will be confusing to a consumer, but I have videos on it that talk about the M.O.P rating system. And on a lender's credit report, and on some of the reports that are there, and on some of them they aren't displayed, you could ask your credit vendor for them if they're not there. But there's this rating system. It goes 0 through 9. 0 means an item is unrated or too new to rate. 1 means that it's 30 days late, but not yet. Sorry. 1 means it's on time. 2 means 30 not yet 60 days late. 3 means 30 not yet 60. 4 means 60 not yet 90. 5 is 120 plus. 7 is bankruptcy. 8 is foreclosure or repossession. 9 is collection, charge off, profit, and loss. When a collection is a collection, it's a 9. Charge off, profit, and loss, they're all 9s, right? When that account gets more aged, that 9 gets further away from the date of last activity, gets further away from today's date. When you pay it off, the 9 rating associated with it doesn't update to anything else. It just follows that date of last activity. So that's where the confusion is in the algorithm. So anyway, sorry I had to explain that whole backstory, but that's why when you pay a collection off, the credit scoring algorithm basically goes, oh, a 9 rated account and it's today. And it doesn't see, oh, but $0, this is a good thing. It sees it basically as a new collection.
And so the pay for deletion, right? You're actually paying it, but they're not reporting it for today's date.
Yeah, I mean, in an end all be all, we're saying we want this thing off the credit report entirely. When our client makes this payment, we want you to remove this from the credit report. And there are some companies that do. There are some companies that will, in my opinion, lie and say, oh, we can't do that. That's against our policy. That's against the law. It's not against the law. It's each creditor. It's in each creditor's discretion, at each creditor's discretion, what they want to report, as long as it's accurate. And so if they wanted to delete it from the credit report, they're more than welcome to do that. And we have companies all the time that will do that. If they're not willing to do that, then there's a plan B, a plan C, a plan D, and just to get resolution on it.
Okay. Now, you made a comment about how like the better your credit is, the more fragile it is. And this kind of leads into a question from last night on Facebook somebody had, where, just working with a lot of clients, I think one of the situations that popped out to me when you were talking was I have this A+ borrower. This guy has amazing credit, assets, just an amazing history. He's the person you want to loan money to.
Right.
What happened was when his loan was transferred or something of that nature, I can't remember the exact thing, he missed one payment. It was a 30-day late.
Mm-hmm.
And he couldn't get it off, and everything just changed for him, his credit score. How does somebody like him, who's an A+ borrower, recover from a mistake like that?
Yeah, so you got a couple options. First and foremost, if you have a good banking relationship with that company, I would try what I call a goodwill action. You call them up, you say, I know that this wasn't your fault. It also, I don't believe was my fault because of this. Even if I just forgot about it, it's just, I wasn't maliciously missing the payment. Come on, guys. I'm a good client. I'm a good risk. And I would think you would want my business going forward. And so I'm asking for a goodwill action, and I would love to put up a 5-star review for you. Something like that, where you just say, will you help me out one time? Like, that this was a mistake. They very well may say, no, that's not an option. If that's not an option, you just have to bite the bullet and work around it. And when I say work around it, what I mean is really focus on your other accounts, because that late pay is the late pay. All you can do is pay it on time going forward. That's it. If they're not willing to work, you can challenge it to credit bureau level, but a recent valid late pay, we don't even mess with those because they're probably going to get verified.
Right.
Then what you want to do is you want to focus on everything else. Do I have positive trade lines? Am I making my other payments on time? Are my credit cards paid down? Or am I losing a ton of points by having those maxed out? Because there are other ways where you can just go, you know what? It is what it is. I lost 40 points. I got to get them back somewhere else. And I can look at any credit profile and say, here's how you're going to get 40 points.
Really? Okay.
Yeah, I mean, whether it's adding positive trade lines, whether it's, removing inaccuracies, whether it's paying something down or transferring a balance here, or, calling up your credit card company and having all your limits increased. I mean, there's always, unless I guess I shouldn't have said that. If somebody's at a 800, I might not be able to give them a plan to get 40 points. That doesn't involve doing everything perfectly for another 5 years, but I can look at most credit reports and say, here's absolutely how you could get another 40 points. Now, sometimes it's what people don't want to hear. It's you have a maxed out HELOC and it's your only revolving trade line and it's $100,000. You're going to have to pay this thing. I mean, it's a maxed out revolving trade line. It's just a big credit card. So you're going to have to pay this thing down below 20%. And they're like, well, that's $80,000. I said, well, you to ask me how to get 40 points,
Right.
So sometimes it's that situation, but I can still look at it and tell you how to make it happen.
Sam, we've been working together a long time, and I never considered borrowers you able to help them in situations like that. Does that make sense?
Yeah.
You kind of think like, yeah,
Send them over.
When we finish this.
Yep.
Here's some other questions I have for you, just based off Facebook. This is one I thought was very interesting. You have credit history. So you have credit cards and utilization and stuff like that. I think it's like 30%. Is that the limit you want to be at for the best score? 30% or lower?
30 or lower, yeah.
30 lower. But is there a difference between older, like would it benefit you more to use older credit cards versus newer credit cards? Is there any formula for that?
So kinda. It's a combination. First of all, what you want to do, if you had to choose, if you said, I have this 10-year-old credit card and I have a 2-year-old credit card, which one should I use? And I'm going to keep one in my wallet. I would say use the 10-year-old one because you've built up a ton of pay history on that one. If you don't have activity on a credit card for 6 months or so, but usually more like 3 is what we're seeing. If like you left a credit card in your wallet, they're not going to give you credit for the pay history associated with it. They're not going to, because it's a risk-based model and you're risking nothing because you're not using it, right? And so if you were going to keep one active, I would want you to keep the one with the nice long pay history active. Now you keep it so it's weird because it's like one component of the credit scoring algorithm keeps it active so that you get credit for the other component of the credit scoring algorithm. Meaning, again, if you were going to maintain just one credit card, I would say, okay, then get that old credit card, the one that's 10 years old, and I want you to use it wisely. I want you to keep it, never above 30%, but ideally between 5 and 10%. And here's how we're going to do that. We're going to put a tank of gas on it every month. We're going to pay off, we're going to pay the minimum the next month, and then we're going to pay it down to $10 the next month, tank of gas, and then do that like that. And then by doing that, then you're going to get full credit for the 15% of the pay history. And since this thing is so old, that's going to be a much larger factor than the 2-year-old credit card.
That's huge because like what happens?
Yeah, so it's all kind of interwoven.
I've never knew that. This is great because usually what happens is people use their old credit cards, then they get like the 0% interest card over here. Then they focus on that one, and then they even consider closing the older ones.
So here's what they do. And I'm not saying this to be mean to anybody, but they're looking 6 inches in front of their face because they're like, I'm going to put that credit card away because they charge me a $30 annual fee. And when I use it, it's at 16%. And it's like, okay, so do the calculation on a $30 tank of gas at 16%, and then the $30 and what it does for your pay history and your credit score. Now, when you go to get a home loan, if your credit score isn't above a 720, now do the math on the interest rate, on PMI, on all that. And to save $30 a year because you didn't look at your credit as a tool or as a game that has rules to it or as a financial mechanism to access hundreds of thousands of dollars at the lowest rate possible, because you didn't look at it like that, now you're going to cost yourself tens, if not hundreds of thousands of dollars, or miss out on the opportunity altogether. And then I got to teach you how to calculate opportunity cost, which is a whole nother thing. So anyway, that's my rant. But it's just people don't realize, like, they look at credit as the final destination, and it's not. It's a way to get access to hundreds of thousands of dollars at as close to free in terms of interest rates as it's ever been. And if you closed out a credit card because Dave Ramsey told you to, and it made your credit score drop 80 points because it was your only credit card, now you missed out on almost every opportunity.
So that leads into another question here. Sometimes you have limited history. Maybe you don't have any history. Believe it, I love it when I don't love it, but it's unfortunate when people say, hey, I have great credit because I don't have any credit.
Right.
And my heart kind of sinks because it's like, okay, what's your next step? How does somebody effectively build credit? Some of the things that we've been using is, authorized user on other people's accounts.
Yep.
But people even have questions on how to even start credit.
Yeah. So, first of all, I want to get people's minds wrapped around credit, right? And so to kind of play off of what you just said, I have great credit because I don't have credit. That's like saying I'm an awesome quarterback because I've never thrown any interceptions. And then I go, cool. So how many games have you played? None. Well, you're not a great quarterback. You just have never tried. And so that's and the reason I relate it to football a lot or games a lot is because it is, if you look at it like that, it will serve you well. It's a game with rules, and if you win the game, then you get access to money when you want it at really low interest rates, right? And so to start off, what you want to do is just some nice, easy things. You want to get a credit card. You want to get a low limit credit card, a $500 card, a $1,000 card if you're worried about it, a secured credit card. We have access to the Credit Builder card. It's a $200 secured card, reports to all 3 credit bureaus, shows up on credit within 2 to 3 weeks. So what I would suggest if somebody was like, I have 0 credit, Sam, what should I do? I want to generate credit scores. I'm going to tell you to take on debt because that's how you get a credit score, and that's the rules of the game. Sometimes people, they're like, why do you want me to take on debt? It's like, I don't. I live in the credit world, okay? I'm just telling you how to have an excellent credit score. And in order to do that, you got to have the proper mix of credit, okay? The mix of credit is actually makes up 10% of the credit score, but it's more than that, because if you don't have the proper mix of credit, you'll have a no score. So when somebody goes to pull credit on you, it's not that you have zero credit, it's that you don't have the proper type criteria to even generate a credit score, so they're not going to give you one, right? And so to generate that credit score, what you're going to want is at least 2 revolving trade lines, and that's a fancy way of saying credit cards.
Right.
So with that credit builder card that I'm talking about, and the reason that I push it is not because I make money off it, it's because I've used it thousands of times, and it's been an amazing tool that works like a charm for our clients. So again, what they've allowed our clients to do is to stack 2 of them, meaning they can open up 2 credit cards on the same date. They have to remember to make 2 payments, but that will a lot of times generate a score. But in an ideal world, I want them to have an installment loan too, which is a car loan. So many of us already have a student loan, a mortgage, something like that, where it's a fixed payment. That's an installment loan is when you apply for it. They say, yeah, here's what your payment is. There's a fixed term on it. Here's how long it's going to be. And again, car loan, student loans usually going to satisfy that.
No, that's great, because a lot of people don't even know. I mean, they just go, okay, I'm going to go build credit, and they go apply with Visa or something like that.
Well,
and they get denied, right? Because they don't have any history.
Right.
So you need a place to start. So you have a great tool that they have that can get their credit score at least momentum going.
Yeah. The other thing that they'll do,
stuff like that, like after they have that, how long should they stay in that card before they'll get approved for this?
Sure. Yeah, great question. So the other thing that I want to kind of warn people about, and I always look at things with a skeptical eye when it comes to credit. So I'll try not to do that with this, but you do have banks out there that are like, oh, come in and get a CD with us and it'll report to credit and it'll help you build credit. And I'm just saying that an installment account doesn't help you near as much as a credit building credit card. So when you go and you get like an auto loan alone, that's not going to generate a credit score. They want to see that proper mix of credit because, again, it's a risk-based model. So in the grand scheme of things, what you got to think about it is to go back to that game reference, right? It's like you have scouts in the stands and they want to see you play. They want to see you take these risks. And if all you're ever doing is handing the ball off, which would be like an installment loan, you're never making a pass, which is a lot riskier. They have nothing to judge you on. So nobody's going to recruit you. Nobody's going to lend money to you, right? And so you got to think about it. Yeah, so you got to think about it like that, there's somebody watching you. So what do they want to see? They want to see your skill set. They want to see you use a credit card and use it wisely. They want to see you use 2 or 3, really. I mean, in a perfect world, in order for you to have a really high credit score, they want to see you expose yourself and for you to manage that risk properly. So what I would do is I would start off with those low limit credit cards until I can see, and I would monitor my credit on a consumer site constantly. Every month I would look at my credit report. And as that credit score gets up into the mid 600s, I'm going to start applying for what I would call normal credit cards, credit like your normal Visa card that's not a credit builder card. And I would be asking for a low limit, depending on my income of, I don't know, $1,000, $1,500, $3,000, something like that. And I would know that this is not money, that this is not a spending spree, that's about to be approved, that this is something that I'm going to keep since it's a $3,000 limit. I'm going to make sure to always keep it under $300 so that I'm maximizing my credit score. And I'm going to use this so that when the house of my dreams pops up, or when the opportunity of a lifetime pops up, and I go to a bank that I go in with my head held high, and then I'm saying, do you want my business, or am I going over to this bank and I'm giving them my business? Because right now, when you're walking around with a 570 credit score, all you're doing is going, will somebody please help me? I'll take whatever I can get. And we know that because you look at the auto industry and you see when they go to when they see the ads for 0% interest for the first 6 months, as long as your credit is good, and you go there thinking you're going to do that, and then you end up at the buy here, pay here place 3 miles down the road with the lemon. We know that people want and will take what they can get, unfortunately.
Yeah,
so,
I can tell you from a lending perspective, there is a major difference sometimes with rate in just 40 points of credit score. I mean, half a point in rate. It's absolutely now more than anything. So let's kind of build off this into bankruptcy. So someone has a bankruptcy. Actually, let me take a step back. So your credit card, right? And you mentioned like monitoring their credit. Now,
Yep.
do you guys do that? If someone had no credit, would you help them build and then they'd have that? Because I use your portal, right?
Yeah.
Monitor
So
their credit that way too as well. Can you help them with that?
yeah, so we just give them free information. We just, we have several resources for them to use. We have, a library of about 40 different credit education videos. And then we could send them that link directly, or actually, Paul, at the top of your portal, it says credit builder card. And if there's ever anybody that needs it, you just copy that, send it straight to them. If they want our guidance, we're there for them. But there's some people that are like, listen, I need a credit card. I don't want to talk to a credit repair guy unless I have to. Just user experience wise. So we make it available to them, but we would absolutely guide somebody on how to establish credit. And if they went to our website and spent 10 minutes there, they would be able to find that info as well.
Awesome, man. So bankruptcy. So someone has bankruptcy, they eliminate everything.
Yep.
Can they use the same strategy in rebuilding their credit, opening that credit building card and stuff like that?
Yeah, and that's exactly.
People don't build their credit after, so it's been 3 or 4 years, which is great, but they don't have any new debt, so we can't. Again, we're in the stands watching, and they're just calling. I don't know what they're doing. They're not off or throwing it.
Exactly. So let's keep going with that analogy. So it's like after you have a bankruptcy, it's like you got cut from your last team, but the other quarterback on this new team that picked you up got hurt, and you're getting back in the game right now. Okay. And these people are in the stands going, what is he going to do now? What is she going to do now? What are they going to do? And you get the snap and you kneel because you say, you know what? I had a really bad time before. I know I got a fresh start now, but I want to do nothing with it. Right? That is what you're telling to the scouts in the stands that are looking at you. That's what you're telling to the banks that are not going to want to lend you money because, yes, you got in over your head. It happens. It's unfortunately, it's almost the American way, right? But you learned your lesson. You filed that bankruptcy, and some people go right back out and they start making the same stupid mistakes, and you don't want to be that person. And I understand that, and that is great. That is fine. But you're smart enough to not do it again. You know what got you there, and it's one of two things, really. It's either circumstances that you couldn't control, and that's no reason to not play the game again, or because it's not a game. It's you, it's your family, it's where you lay your head, right? And so to not play the game means you're going to be paying somebody else's mortgage more than likely for a good part of your life, which means you're not saving up for your kids, and I could go on and on, right? But so either it was something that you couldn't help, or you did some dumb stuff, whatever. You made a bad mistake, whatever. So my question is, are you being a productive member of your community and of your family? If right now you're sitting back there, not rebuilding credit, not getting ready to make that purchase for your family when they need it, or even having it, don't use it. Don't use credit if you don't need it or want it, but play the game and play it wisely. You're saying you can't manage a $300 credit card. Come on, you can. You just have to do it. So to recover from a bankruptcy, what you have to do is you have to reestablish credit and use it wisely and have a strategy with it. The other thing is, remember those M.O.P ratings we were talking about. All of those, for the most part, all of those items that you filed bankruptcy on, the credit card, the cell phone bill, the medicals, all those things, they are still going to have that 9 rating. It is going to say on the credit report, it's going to say account included in bankruptcy, $0 balance, and it's going to say $0. But if you look at a lender pool that has M.O.P ratings, almost always it's still going to have 9s, which means that consumer is being hurt just as much now by that account as they were before the bankruptcy. Since that M.O.P rating isn't present on consumer reports, the client never even knows that they need to address it. So what we would do in that situation, or what the consumer can do if they know what they're doing, is they can go to the credit bureaus or to those creditors, and they can say, you're reporting a 9 M.O.P rating right now, which is killing my credit. You have to update this to a 7 at least, and that's the bankruptcy rating. They can also go for a deletion or an unrated status, but there's a huge difference between a 9 and it's not 2 points. It's just a coding, but I mean, it can mean dozens or hundreds of points.
Really? So
Yep.
after what you're saying is after they do bankruptcy, sometimes it's not changed in the credit bureau and it's still showing 9, and that's hurting them more as time goes on. Whereas I'm assuming they have to work with you on this. I wouldn't have no idea how
Yeah,
to.
it's getting into the inner workings of it. But
Crazy.
the messed up thing is that there is no place that a consumer that I know of can look at or find or get access to
Right.
a credit report that would show them, that would make sense as to why I filed bankruptcy. I don't understand it. Everything says paid. Why am I at a 570 credit score? This doesn't make any sense. And it's because those are all still hurting you for the most part just as much as they ever have because of that stupid little M.O.P rating. Same thing with a paid collection. Why is that thing hurting me as much as it ever has? Well, because the rating on it's wrong, and the credit scoring algorithm, once something goes to this status, doesn't care or reward for the balance or payments being made or anything. It's just worried about the date of last activity and the M.O.P rating.
That's crazy.
Yeah.
I would never have known that. Let me go back to some of these questions here, Sam. That's all right. Do you think? Okay, so here's one. I don't really forbearances, right? I haven't seen a credit report yet showing a forbearance reflecting.
Yep.
What are you guys talking about? What I mean, is it going to hurt people's credit score? Like
Yeah. So
down the road, and someone took a forbearance that was offered, needed, totally legit. How's that going to affect their score, or will it?
yeah, so they're coming out with updates saying that, and I think they even did last week, saying that they identified that it was hurting people and that they're fixing it. And I honestly haven't dug into it and tore it apart over the weekend, and I need to. So I'll get back to you if there's an update on that. But from what we know, okay, and what we've seen, both in this case and 10 years ago when so many people were in the same situation, is that it's not a direct, you went into forbearance, so we're dropping your credit scores. It's not a punishment. What it does, though, is that while you're in forbearance, it basically takes that, it's like it puts a bubble around that account, and it's not helping you or hurting you. It's just like, hey, listen, this account's like on pause, basically. So if you were getting maybe 30 points for your pay history on your mortgage or 50 points, that part for the time being is not going to be calculated into your credit score. And so you are seeing a drop, but they didn't mean to do it. Like, it's not like the mortgage servicer is like, and you'll drop 30 points because you put it on hold. It just is a byproduct of it, right? And so as soon as it restarts, then that payment history should restart. You should not, as long as you, in the industry, it's called cure a mortgage at the specified time, meaning with a forbearance, in a lot of cases, they're giving you 3 months off, and then you got to make a balloon payment on the 4th month, or they're going through and they're saying, hey, here's where we're going to disperse these payments. As long as you do that as agreed, you should not incur any late payments. It's only if you said, yeah, I want 3 months off, I'll make the payment, I'll make all my payments on the 4th month, and then you don't, that you could be hit with at least a 30, possibly 90 to 120 or 90 days late at that point. So
that's what we were thinking is so if people can pay it up front, I can see how that wouldn't affect their credit report. But if the lender actually had to modify their loan, right, to the reduced payment because now you owe more, etc., how is that going to show up on the credit report? 2 weeks ago, I guess lenders were saying, no, if you're in forbearance, we won't do your loan. But now they're starting to change that tune a little bit. Great news, right? Because as you said, it was unintended consequences. We go out there to help people. And next thing you know, we're hurting their credit score, and we won't refund.
Yeah, exactly. It's nuts. Yeah. And so here's the deal. In the past with those, we've seen a couple different things. We've seen people get through and do like a loan mod unscathed, as long as, honestly, the servicer is on top of it and the client is. Okay. But if there's breakdown on either side at all, and a lot of times in the past it was the servicer, and it doesn't get processed or something like that, you could end up in a huge mess with late payments and even foreclosure situation. Yeah. So it's just whatever somebody decides to do, it just get it in writing, record the phone call, say it in layman's terms back to them to say, so what I'm understanding is, because that way nobody can ever say, well, I'm sorry if you understood it like that, but it clearly says this, like record that conversation to protect yourself and make sure that you understand what's going to happen and say, so if I do this, no late pays on my credit report, nothing bad on my credit report, correct? And I mean, just spend a couple minutes asking the same question 5 different ways to make sure that you're covered, because we just saw it. I can talk about, again, the way it's supposed to work, and then we can talk about how it worked in 2008 when we saw a bunch of these. And there were people that were told this isn't going to hurt, and then they ended up in foreclosure because the servicer kind of changed their mind in the middle of it,
But I love that advice. When you're talking to your servicer and you're in the process of getting forbearance, you just ask them the question over and over. My understanding is this, right? If I do this, then this will happen. Because they do record the conversations.
Yep.
Right.
And I would strongly encourage a client to record it on their end too, because you never know when we've had it happen several times where we call and we say, hey, we'd like to hear that recording just because your customer service rep told our client this and we acted accordingly. And they'll be like, we don't actually record all. If you'll listen to it, it says that some calls are recorded for training purposes, but we also have the right to recycle those after 24 hours or some BS like that. So I would, if it's a critical situation like a forbearance or somebody agreeing to a pay for deletion before you pay it, just say, hey, listen, I understand that you guys record over on your end. I just want to let you know I'm recording on my end too. Can you acknowledge that I'm recording? Get that customer service rep to say, I do acknowledge that, just to cover yourself. And then you can say, okay, so here's my understanding. And then that way you could absolutely use that recording, if nothing else, for a customer service and social media pressure if you need it.
Right.
Yeah.
Here's another question for you. So when someone challenges or disputes a credit dispute, is it true to say that when you dispute something, it is the credit, oops, my alarm, sorry about that. The credit bureau is acting as if it's not even there until it's undisputed, right? Because a lot of when we have clients, they'll be disputing something and they'll have a 720 FICO score.
Yeah.
But the underwriter will say, hey, that account has to be either solved or take the dispute, right?
Yeah.
And it affects their credit score. Is that?
It's the same mechanism that we talked about with the forbearance just a couple minutes ago. It's like, since you initiated an investigation, it's almost like it backs up and it says, fine, then you're innocent until proven guilty. So we're investigating this. It's like if I try to get visuals on this. It's like if your credit report were like a left to right math problem, right? Like your car loan gets you 45 points, your credit card gets you 27 points, this, and then at the end it equals this. Now imagine you put a bubble around one of those numbers and accounts and it floats up out of that algorithm. And so instead of having 38 plus 15 plus blah, blah, the 15's gone, right? During the investigation or the forbearance, whether it's good or bad. So you do have an artificially inflated credit score during that 30-day investigation period. Now, that rule does get misapplied in the lending world because people got burned in the past. Banks got burned in the past. Clients and even lenders back in the day would come in and they would take an account that had 10 collections and they would dispute every single one of them, repo credit in 7 days. All of those, in that algorithm, if you went left to right, that would say minus 30, minus 12, minus whatever. All those negatives were taken up out of the algorithm, and all of a sudden you only had the positives impacting the score. So you'd have an artificially inflated 660 credit score that if you waited 10 days was going to be back down to a 550. Right. Then what happened was these loans, they'd go to buy them or to sell them on the secondary market to the end all be all servicer. And that servicer was like, we don't want this garbage. Like, we're not taking this. Or they would get them. They were a bad credit risk that was a lie basically put through because of that, unfortunately, and the loan wouldn't perform, and then the lender was having to do a buyback. So the mortgage industry went and said, for the most part, we're not going to have any dispute verbiage anywhere. And then even when we're trying to be like, but this is after that, they're like, we don't want to hear it. No dispute verbiage. So what happens is during that 30-day investigation period, it's taken out. Then it's like the bubble pops once it's verified and that account is dropped back in. The credit score updates, so that 720 that your underwriter doesn't like is now back down to a 680. But what remains is the dispute verbiage. So then even when you try to qualify them with a 680 loan, the underwriter is still like, no, you can't have that on there. And so it's just a risk mitigation mechanism basically, and it takes us maybe 3 to 4 days to go in and get that verbiage removed if it's past tense. And if it is still investigation, then you just wait for the investigation to end. If you get a deletion, it won't be there at all. If it gets verified, it's going to be there, and then you got to take it off.
Sam, that's awesome, man. Hey, I just kind of want to. I went well above your time, and we can just keep going on because there's so much. But there's a lot. There's been a few times where we've talked about using your services, and here's the truth, right? I've been doing loans for 15 years, and my experience is that when people work on their own credit report themselves, they are less successful than when people work with professionals like yourself. And I'm saying that very kindly too, right? I mean,
Yeah.
Borrowers where they're using the same strategies that got them into their credit score over and over, and they're not homeowners. Where people that do invest in you, do invest in themselves, actually find themselves buying a home. And what we do, Sam, and then anytime a client we refer to you, that any money they invest into them with you, once we close their loan, we'll credit them up to $1,000 to just basically pay them back, because we want people to be homeowners. I believe in it. And so what I want to kind of end here is, just tell me the questions I should be asking you, because I fully believe in you. I just don't know always the right things to say, because I know that once I send people to you, we're able to monitor it. They're able to monitor their credit score. Everything's very transparent, which I love. And we get them into homes and hand them their keys. I mean, what are some things that we should be saying to people that are in less credit scores right now to get them over to you and get them towards closer to buying a home?
Yeah, well, first of all, I would tell anybody that's interested, we start with a free review, and there's no obligation. So we look at your credit report, we tell you what our game plan would be, and then if you were really gung-ho about doing it yourself, you know what my game plan would have been. Okay, so then you can take it. Yeah, you could take it and run with it. Or if you decide to use us, our average client's going to pay us $577 over about a 90-day program with us, okay? Some people are faster, some people take longer if they have more debt that we have to work through. But what I would say is, if you know exactly what you're doing, you could probably fix your own credit, right? But that would apply to any service industry. So go on YouTube and watch how to cut your own hair. Never cut your own grass. It's like, where are you going to stop with that? Like, where do you stop with, well, since I can do it on my own, then somebody shouldn't be paid for it, right? And then I ask people, how important is this? What are we trying for? And our clients, right, Paul, are trying to get qualified for home loans. Is this something that you want to experiment with? If you mess this up, if it's not as simple as your brother-in-law with his 590 credit score and all of his opinions and great advice, if his method doesn't work and you're 30 days behind where you should have been by that time if a professional was working on it, is your family good? Like, what sign of, because here's the deal. Most people that we're dealing with are trying to be homeowners, right? Or they are homeowners. And it's very important. And we're dealing with hundreds of thousands of dollars here that it purchases and refis that are going to translate to tens of thousands of dollars of interest and things like that, depending on the credit scores that we can get, right? So what I tell people, and I'm kind of the hard, tough love kind of guy, right? But I just go, is this important to you? Don't think about it as credit repair. Think about the end all be all, the home ownership. Is this important to you? Is it important to get it done as fast as possible? Does a month matter? Does 2 months matter? How much time are you going to have? You're working, right? You're trying to get a home loan. You have a full-time job. And when you get done at 5 o'clock, you want to spend it with your family, not write dispute letters or see if Equifax followed up on what they were supposed to do. So my question is this really important? And they'll go, my God, yeah, it is important. I'll go, now that you think about it, is there anything else more important outside of your family's health, with where they're going to lay their head, where they're going to grow, where your kid is going to celebrate their next birthday? Is there anything else more important? And then they'll go, you know what, Sam, I guess I didn't really slow down and think about it like that. No. And I'll go, well, then let's act like it. Okay. Let's get a game plan going. Let's bring some team members in that are going to help you while you continue to do what you're great at, which is your job where you make money. You're going to pay us a couple $100. I shouldn't say that, 5 to 700 usually. And I'm 75% of the time at least, and more than that, this is just the feedback that we get that we can actually track. We're going to save that client more money in the deletions and the settlements that we get them than they even spend on us. And then they're working with Paul, so they're going to get all that money back anyway at closing. So act like it. That's all I say. If it's really important, which it is, if it's where your kids lay their head, act like it. Let's get to work.
That's awesome, man. I love the little tagline. Big things are about to happen.
Yeah.
That's great, man. I love it.
Yep. It's credit is really the gateway, Paul. It's crazy. You could have not that much money in your bank account, great credit, and qualify for an amazing home for your family. People just don't realize that credit has to be looked at as an equal with income, really, because without one, the other doesn't matter. So, it's just, we'll educate people one by one, Paul. We'll help people together, one by one. But I guarantee that out of this, there's going to be a handful of people that raise their hand and they say, I am ready to make that step, and we're going to be here to help them together.
Absolutely, my friend. I look forward to it.
Awesome.
Right on, Sam. I appreciate your time and answering all of our questions, or my questions. And look forward to getting people into homes.
Anytime, Paul. Thanks so much.
All right, brother.